If you think you might change your living situation during retirement, then let me just warn you that many people make mistakes that could cause them to pay more tax than they actually need to. So this will be a useful video, even if you don't plan on moving for quite some time, because it's going to give you some preparation and allow you to be ahead of the curve so that you're not surprised whenever it is time to move. I actually spoke with someone not too long ago who was really concerned. He felt like he was completely out of options because he wanted to buy this next house in retirement before selling his existing one. He had some reasons for that. But most of the money that he had was in his IRA, his pre-tax IRA, and then pre-tax 401ks. But after a short conversation, we discovered that he actually had a few options, all which allowed him to save thousands of dollars on tax. So I want to share those options with you. By the way, the reason why we make these videos and share what's working with others in retirement is because we can only work with a select number of high net worth families, but we believe this information is really valuable to really just share with anybody and everyone so that hopefully it can help you as well. And if I haven't met you yet, I'm Dave Zoller, and Tim and I run Streamline Financial. It's a retirement planning firm and an investment firm in the Chicago suburbs. And if you do want to reach out for a conversation with me, you can click on the link in the description below if you're close to retirement. I don't always have time available, but I'll get back to you either way. So a couple that I spoke to recently, they're retiring soon, and one of their financial goals is to move to another state, and then they'll sell their current home and they'll buy a new home as well. But they had a problem. All of their wealth was tied up in pre-tax 401k and IRA. And as you know, when you're making a house transition, you sometimes find the next place before your current place is ready to sell, or there might be some reasons why you might have to have two for a little bit of time. And this happened quite a bit to clients in the past who are making a move like this, or who really just want to buy a second home, maybe in retirement, and be snowbirds. And they've got too much tied up in pre-tax monies. And you might have guessed that the negative of this is if you take money out of your pre-tax monies, then it increases what your taxable income is, and it may even shoot you up to higher tax brackets that year that you take a big lump sum withdrawal. There are a few more problems that retirees fall into when they're in similar situations to this, and I'll share the solutions to these as well. We already know about the tax problem. Another one is if they don't have a wage anymore, it may be harder to qualify for a mortgage if they don't have that high income anymore, and if they just don't want to pay cash. Also, the first few years of retirement, that could be the Roth conversion sweet spot for many. And if you're taking withdrawals out of your IRA for lump sums or down payments on houses or thing like that, then that can throw the conversion strategy out of whack. And then also withdrawals from IRAs, that can increase how much you're paying for healthcare costs too if you're under 65. But those are some of the problems. Let's get to some of the solutions now. So these may be out of the box ideas for people who are in a situation where they may not qualify for a big enough bridge loan or something like that, or a mortgage if they're in retirement. The first one I'll bring up is one that I mentioned to people, but I usually don't recommend it. It is actually, people will usually bring it up to me. And by the way, these solutions, they're just ideas to get the wheels spinning so that you can see if it may be a good fit for you. But as always, talk to your financial professionals or tax professionals to evaluate all the options to make sure that it fits your situation before doing anything. Or another option too is look to map things out using the DIY retirement planner below. You can find that link below. So if someone's in the process of selling one house and then buying the next one, and they find their new house first, and their money is all in pre-tax accounts, they sometimes bring up the idea of doing a 60-day rollover, which is basically taking money out of one account, pre-tax account, and then if you're able to add that same dollar amount back into another pre-tax account in under 60 days, you shouldn't have to pay tax or penalty if you're under 59 and a half. So 60-day rollover is really meant for 401ks where it's coming out of a 401k and then getting into an IRA. There's the 60-day period where you can get it and there's no tax impact of that. But some people may think about using this as almost like their own bridge loan where they can get it, buy the second house, and then hopefully their existing house sells, they get the proceeds, and then they can add it back to the IRA. But to me, that's risky business. We both know that house transitioning, when you're doing this, it never goes as smoothly as we want, and things get delayed, or the sellers or buyers, they have different stipulations. So it's just not worth adding that time constraint to your life if you don't want to, if you can avoid it. Because if it doesn't all go according to plan, then that can mean thousands of dollars that you pay in tax. You know, personally, it's stressful enough. Last time we moved from one house to the other, there's enough going on to raise your levels of stress. There's so much to do. And we did have a 3-year-old and a 2-year-old at the time, so that could have been part of it, but I'm sure you know what I mean. Adding a 60-day timeline to it all is just something that could be avoided if possible. Now, something that we've seen in the past that has worked for some clients who wanted to increase their income after their wage was done, after their work was done, because they wanted to qualify for a mortgage, was that they may increase withdrawals from their pre-tax accounts, say their IRA, to increase taxable income each month systematically. And that may allow the bank to give them a better rate. Now, this is something we've done or seen done in the past. Talking to mortgage officers who are helping people get qualified for mortgages may bring this up. And I haven't seen this in a while, and I actually don't know if they recommend this anymore, but last one was maybe 3 or 4 years ago, where someone raised their income to get a better rate for a mortgage that they ended up paying off in the future anyway. So that's one other thought. Something similar to this, or at least using 401k talk, is some people bring up 401k loans, taking a loan from your 401k to help with part of a down payment of a house purchase or a house purchase. Now, some 401ks allow you to take out either half of the balance or 50k, whichever is less. But there's negatives here too. Like you don't get the growth in the 401k once you take that money out, right? If it's long-term monies, you're not getting the growth. You have to pay back the loan, sometimes within 5 years, often is what we've seen. There's different rules for different plans. So talk to your tax and financial professionals before thinking about that. But that also is kind of a time constraint when you're thinking about this, but we've seen it in the past. Now, the next solution is one that I actually like a lot, even though many people's first reaction to it is, I don't want to do that. And that's to pay for flexibility by renting in the area that you're going to be moving to. And we've seen this scenario. The reason why I like it a lot is because I've seen the positive things that have come from this. And I've also seen the negative things when people just get their new house right away in this new area. So the scenarios that we've seen play out when someone buys a house in a new location, they find out maybe a year later something just is a little bit off. It might be that they're having a hard time creating new social connections in this new area. They didn't know that's what would happen. Or maybe they don't like the distance from their family back home, or the weather isn't exactly what they thought. Maybe it doesn't seem like big things, but it's enough for people to second guess their decisions after they've already bought this house, and it's just been a short period of time since they've done so. And I actually asked a bunch of retirees who have moved to a new state. I asked them for advice, and I shared what they said in a separate video that I'll link to towards the end of this video if you want to get their advice on things. Now, on the flip side, we've also had clients who move to a new location and they look for either a short-term rental, 6 months, or maybe a year rental. That way they can test the area, make sure it's the place, that the connections are there. And if it's not right, they can easily look around that area to different communities and things without that feeling of being too tied in with having to stay in that place because they bought. And they don't have to worry about selling the house for, and paying 6 to 8% after all the closing costs and things like that if they were to make another transition. So that's just something to think about. So let's go over the next solution, and then I'll share an idea if being debt-free in retirement is really important to you, but again, you've only got most of your money in pre-tax IRAs and 401ks. Before I do that though, if this has been helpful so far, please like the video or subscribe so that hopefully it can help other people as well. So the next solution is, if you're a few years out before retiring, or maybe just a few years out before doing a house transition, before buying another home, what to do is see if you can add to your non-retirement funds or maybe your Roth accounts over the course of a few years. It might be adding to it just regular contributions, or it might be withdrawing from pre-tax accounts, but spreading out how much you take out of pre-tax accounts and getting it into the non-retirement accounts over the course of a few years. That way, if you take a big lump sum in 1 year in the IRA versus spreading it out, you may be saving quite a bit of tax that way. Or if you're still working, it may be even funding your non-retirement accounts before your 401k if you're working. Now, again, that's something that is, you might think that's not the normal thing to do, and it's not. These are just ideas. They're not recommendations, but clients, when they get clear on their goals, and they're able to design that financial plan and kind of see the right path, what the future holds, then it could make a lot of sense for them. Now, how about that person who needs to be debt-free in retirement? So no mortgage, but they don't have enough cash or non-retirement accounts to pay for the new place. They just got the IRA or 401k. Here's the idea. What if you went against the plan of being debt-free, but only for just a few years? And the reason for this is, you guessed it, it's tax reasons. Instead of taking out a big lump sum from your IRA and paying tax on all of it, what if you only took enough for, say, a down payment so that you don't shoot up to the highest tax bracket? And then next year, maybe take a little bit more out of the IRA up to a certain tax bracket, but not to the highest one, and then use that to pay off the mortgage in kind of a big chunk. And then do that again the next year. Over the course of 4 to 6 years, you could end up paying a lot less in tax than if you were to just take one big lump sum from your IRA. So for those who want to be debt-free, yes, I know the feeling, I know the importance of that, but there might be a way to help save on tax by having a mortgage for a little bit, but paying it off more rapidly. So we went over a bunch of things here. It's a lot. And with each one of these ideas, there's many other things that go into them. And I know I say it all the time, check with CFPs or CPAs before making big financial decisions. So I hope that you found this valuable. And if you did, please click the like button, or I hope to see you in the next video if you subscribe. And if you're looking for that video on advice from retirees who have moved to a new location, it'll pop up on the screen shortly. And then hopefully I'll see you in the next video.